Hello and welcome to Takeaways. My name is Jordan Brooks, Director of Market Analytics with ALN Apartment Data. And this month's newsletter was a mid-year checkup on multifamily performance. So kind of a look back at the first half of the year, where we're at from the typical multifamily performance metrics, what it might portend for the rest of the year and into next year, and then kind of adding some context points for how this year is playing out relative to the recent past over the last few years. And of course, it's been a highly volatile period, so there's plenty to talk about. One aspect of sort of industry performance and influences on performance that was not in the newsletter was a look at some of the economic influences for multifamily. We really kind of hit all of the multifamily metrics. We didn't have the space to get into some of the broader context in the economy. So I wanted to spend just a minute on that here today. The first thing to touch on is the unemployment rate. And this can be more or less valuable sometimes given the state of the economy and kind of what's built into that and what isn't in terms of other data points that affect the unemployment rate. But in general, the unemployment rate ended June at 4.1%. That's down slightly over the last 12 months. And so, decent shape there. We're not down under the 4% mark as we had been for quite some time, certainly pre-COVID, and then even after COVID a little bit in the 2022-2023 period. But 4.1%, pretty good on unemployment. Now, one aspect of the unemployment rate is that sometimes we can see an improvement in the unemployment rate, but it's because people are leaving the job market, not because people are getting hired. And so in that case, the unemployment rate declining can be a little bit misleading. Now, you could make the argument that that's what's happened in recent months because the labor force participation rate is actually lower now than it was at the beginning of the year. But if you dig in below that headline number for the labor force participation rate, what you'll find is that most of the decline over the last 6 months has actually come from the 16 to 19-year-old worker segment, which is not as relevant, obviously, for household formation and housing demand. So a little bit of a caveat there. So I think when you pair that with the unemployment rate making a little bit of progress over the last year, it's a pretty good picture from an employment perspective. Inflation obviously has been a big topic for the last few years as well. Over the last 12 months, we've seen inflation increase by about 2.5%. which is much better than where we were a couple of years ago, but is still higher than the Fed's 2% target. You probably will have seen that inflation tick back up a little bit in the last month's reading, and that is true, but I just wanted to point out that the month-over-month data for CPI, Consumer Price Index inflation, is quite volatile. So, for example, in March, the CPI actually came in negative for monthly change, so prices went down. And then in April, it sprang back up. And then in May, we had an increase, but a much smaller increase. And then June, the increase was larger again. So this bounces around from month to month. Overall, when you kind of smooth that out over a 12-month period, I think that's where we get some useful information. And we're down over the last 12 months relative to the previous 12-month change. If you go back just to January of this year and look at what the CPI movement was over the last 12 months ending in January, we were at 3% inflation, whereas now over the last 12 months, we're at 2.5. So even with the monthly bouncing around, we're still moving in the right direction. Average hourly earnings, so what are wages doing? Again, for big portions of the last few years, inflation was actually running ahead of wage growth, which meant that even if we were getting wage increases, the sort of net impact of prices going up and wages going up was that wages were going down in terms of the purchasing power of your dollar, right? So for average hourly earnings now, over the last 12 months, we've seen a 3.5% gain. Usually anything over about 3.4 is considered good for 12-month change. So we're in the green zone in terms of wage growth. And then also comparing that 3.5% gain in wages to a 2.5% gain in inflation, we're comfortably ahead of inflation in terms of wage growth, which is also good for housing demand and multifamily demand specifically. New home sales. So the single family side continues to be fairly anemic, and it's more complicated than, a weak for sale side is better for multifamily demand because in general, a healthy housing market is a sign of a healthy economy, which is good for apartment demand. But nonetheless, it is the case that people have to live somewhere, and if they're not buying houses, they're probably renting. And so in the short term, at least, that can be a boost for multifamily demand. And in terms of the picture on the single family side, it seems fairly clear that until interest rates come down, we're not going to get a lot of action on the for sale side. So new homes for sale have continued to move at a decent clip, though well below the sort of 2020, 2021 peak. Existing home sales also continue to be quite low, but instead of falling consistently year over year for the last couple of years, we're basically right where we were a year ago in terms of monthly existing home sales. So it seems like maybe that's leveling off a bit. And again, interest rates have not come down materially. Single family housing prices have not really come down. In fact, nationally, we're still at a year-over-year gain for housing prices. Only in the South region, according to the National Association of Realtors, have we seen a decline, and that was only by 0.6%. So a pretty moderate decline relative to the gains that we've seen over the last few years. So all of that to say, the newsletter made the point that apartment demand has come in a little bit higher than we thought it would so far this year, and that's driving positive gains in the occupancy area and the rent growth front. So I wanted to kind of give some context around, some areas that might be impacting that positive demand. And in general, we're seeing strong wage growth, good unemployment, good labor force participation. Again, when you look under that headline number, and then the single family for sale side continues to be at least a little bit of a boost in certain markets for multifamily. With that, I also wanted to point you to some blog posts that we've recently published that pair well with the most recent newsletter. So the newsletter was kind of a high level view across the performance metrics for the start of 2025. On the blog, we have a deeper dive at occupancy, looking at occupancy specifically. So occupancy trends over the last year or so. We also have a post up for market leaders in new supply and market leaders in rent growth. So make sure to check those out. That's alndata.com/blog. And then in terms of upcoming events for me, I'll be speaking at the Idaho Economic Forecasting Conference, August 7th in Boise. So if you're going to be at that event, be sure to get registered for that. And then other than that, be sure to look for ALN Apartment Data on your social media platform of choice. We're always putting up great content and good announcements for you to be aware of. And we will see you next month. Thank you.